Peter Lynch is the legendary investor of all time, known for his exceptional stock-picking abilities and his tenure as the manager of the Fidelity Magellan Fund. He took over the fund in 1977 at the age of 33 and ran it for 13 years. His success allowed him to retire in 1990 at age 46. Today, we dive into the world of investing and learning from one of the greatest investors of all time, Peter Lynch. Whether you are a professional investor or someone who is trying to learn the art, keep watching till the end to get the best out of his leading guidance. However, before we move forward, make sure to like the video and subscribe to our channel to get similar investing guides in future. So let's start by unfolding early career of Peter Lynch. In 1977, Lynch was given the opportunity to manage the Fidelity Magellan Fund. Over the next 13 years, Lynch's investment strategies and stock picks propelled the fund to become one of the most successful in the world. During his tenure, the fund's assets grew from $20 million to over $14 billion, seeing a whopping 29% spike. He is hugely known for finding companies that are called 10-bagger stocks that will increase in value by 10 times or more. He believes that these types of companies are the key to achieving long-term success in the stock market. Lynch also stresses the importance of thorough research and due diligence when selecting stocks. He advises investors to visit the companies they're interested in and talk to management to get a better understanding of the business and its prospects. In addition to looking for 10-baggers and conducting due diligence, Lynch also emphasizes the importance of diversification in a portfolio. He suggests that investors should have a mix of growth and value stocks, as well as different sectors to spread out the risk. In 1990, Lynch retired from his position at Fidelity, but his investment strategies and stock pick abilities are still admired by investors today. Key investment principles of Peter Lynch. Lynch's success as a fund manager was not limited to his time at Fidelity. He is also a successful author of his book, One Up on Wall Street, in which he discusses the philosophy of investment. With his investment strategies, he consistently outperforms the market and generated substantial returns for his clients. In this video, we will review 9 of Peter Lynch's investing principles that can help you beat the market. Principle 1. Invest in what you know. Lynch believed that investors should only invest in companies that they understand. He says that investors who have a good understanding of a company and its industry have an edge in identifying its true potential. This is because they are better equipped to understand the company's financial statements and to identify any red flags that may indicate future problems. Principle 2. Look for companies with a strong competitive advantage. Peter Lynch claimed that companies with a strong competitive advantage, such as a patented product or a dominant market position, are more likely to outperform the market in the long run. He thinks that companies with a competitive advantage are better able to protect their market position and maintain their profitability, even in the face of economic challenges. Principle 3. Focus on growth. Lynch recommends that investors should focus on companies that have a strong track record of growth. He says that these companies are more likely to continue to grow in the future and therefore have the potential to generate higher returns for investors. Principle 4. Pay attention to the price-earnings ratio. Lynch believed that the price-earnings ratio is one of the most important indicators of a company's value. He suggests that investors should look for companies with a low price-earnings ratio, as this may indicate that the company is undervalued and has the potential for future growth. Principle 5. Look for companies with a strong balance sheet. Peter Lynch thinks that companies with a strong balance sheet, including low levels of debt and a solid cash position, are more likely to weather economic challenges and maintain their profitability. He thinks that these companies are better equipped to take advantage of future growth opportunities and generate higher returns for investors. Principle 6. Invest for the long term. Lynch believed that investors should focus on long-term investments rather than trying to time the market or make quick profits. He says that long-term investments are more likely to generate higher returns and provide a more stable investment experience. Principle 7. Avoid overhyped companies. Peter Lynch strongly recommends that investors should avoid companies that are overhyped. as these companies often have unsustainable business models and are unlikely to generate long-term returns for investors. He thinks that these companies are often more focused on short-term gains and are less likely to be able to withstand economic challenges. Principle 8. Diversify your portfolio. Lynch believes that investors should diversify their portfolios rather than putting all their eggs in one basket. He says that a more diversified portfolio is more likely to generate stable returns and protect against market volatility. Principle 9. Stay committed to your investment philosophy. Peter Lynch believes that investors should stay committed to their investment strategy, even in the face of market challenges. He thinks that a consistent investment approach is more likely to generate long-term success and provide a stable investment experience. Peter Lynch early predictions. One of Lynch's most famous predictions was his call on Haynes Corporation. In 1984, Lynch identified the company as a strong investment opportunity due to its dominant market position in the underwear industry and its potential for international expansion. He subsequently invested heavily in the company, and over the next 6 years, Haynes' stock price grew by more than 1,000%. Another notable prediction was his call on Walmart. In 1990, Lynch identified the retail giant as a strong investment opportunity due to its efficient business model and potential for growth. He subsequently invested in the company, and over the next 10 years, Walmart's stock price grew by more than 500%. Lynch also was successful with investments in LL Bean. In the late 1970s, the company was trading at a P/E ratio of 15. Lynch believed in the company's strong brand and potential for growth and held onto the stock for several years. The company's stock price eventually rose to a P/E ratio of 30, resulting in a 100% return for Lynch's investment. Although Lynch believes that trying to predict the short-term fluctuations are not worth the effort, his investing philosophy will help you stay on the right direction as long as you follow. In conclusion, Peter Lynch's investment philosophy and performance stands as a testament to his stock-picking ability. Despite the risk of over-diversifying his fund, owning thousands of stocks at certain times, Lynch became a master of studying his environment and understanding the world both as it is and how it might be in the future. By following these principles, investors can develop a long-term investment strategy that is designed to generate consistent returns and protect against market volatility. Thank you for watching, and don't forget to like and subscribe for more investment tips and strategies.